Let's look at the disadvantages of impact first investing. Impact first investing prioritize social and environmental outcomes, over financial returns, which comes with some potential disadvantages, particularly for investors looking for competitive financial gains. And so here are some of the main challenges with impact first investing. Number one is lower financial returns. Lower financial returns. Impact first investors often accept below market returns to achieve social or environmental impacts. This may limit wealth building opportunities compared to traditional investing. When it comes to traditional stock market investing, you discover that the returns obtainable, with the use of impact first investing is relatively low. So you must take this into consideration, because with the aim of affecting the environment positively, you are likely to give up a decent level of profits as a result. Number two is higher risk exposure. There's that exposure to higher level of risk. So impact first investments frequently support early stage ventures or underserved markets, which tend to carry higher risk due to factors like market volatility, regulatory changes, or unproven business models. We're dealing with some emerging companies, startup ventures. So you have to be very careful, because the risk that is inherent in this kind of investing is quite high. It is a known fact that many startup investments don't yield results. Some of them, many of them normally go bankrupt within, within a short period. Number three is limited scalability. Limited scalability. In this context, you discover that many impact focused businesses, they kind of face challenging, scaling or expanding their operation due to their emphasis on social outcome, which can slow growth or reduce profit margins. This may limit the overall reach and profitability of the investment, because you are so strictly concerned about how the investment impacts the community that you cannot just expand anyhow. You have to be meticulous in your expansion, meticulous in the areas you go into. You have to be very critical the kind of business you get involved in, when it comes to expansion and scalability. So it has that limited scalability compared to traditional companies in the stock market. Number four is longer time horizon. Is that you must have that long-term focus, because when it comes to achieving meaningful social or environmental impact, this typically requires a longer investment period. And so impact first investments may take years to slowly show or indicate measurable outcomes, which can be challenging for investors who are seeking for quicker returns. It's not for those who are looking for short-term gains. No, you have to be patient, because it takes time. Social impact, it generally takes time to happen. So it's not for short-term investors. Number five is measuring challenge. Measuring challenges. Measuring impacts can be a bit complicated, actually. It is costly, and at the same time is time consuming. It takes months, It takes years to measure the growth, the performance, the progress of the impact you want to achieve. This is often no standard. There's often no standard approach, and many impact metrics are, qualitative or subjective. They're not kind of quantitative. It's kind of qualitative and difficult to measure, which makes it difficult to gauge, to successfully measure or gauge consistently. All right. When it comes to, let's say, improvement in healthcare, enhancing education, so how do you go about measuring that impact? It might take time. You have to measure the performance of each pupil in the school compared to when you came in, and that could be data that may involve months, if not years. All right, so it's quite challenging to measure actually. Number 6 is resource intensive. Many impact-first investment requires additional support, such as capacity building, mentoring, or technical assistance. You must have personnel on ground that would provide the mentoring, that will act as mentors, that will be there to build capacity, to render assistance, to make sure that the aims and objectives of the company or the venture involved is achieved. So it is resource intensive, both human resources and material resources. It's intensive. Number 7 is a limited exit opportunity. Limited exit opportunities. And the market for impact-first investing can be smaller or less liquid, which can complicate exit strategies. Selling or transitioning out of an impact-first investment may require time and strategic planning. You can't just easily, like what is obtainable in the stock market, just go into the market and sell your shares. No, it doesn't work that way. It needs strategic planning on how to exit, and that will take time. Number 8 is potential mission drift. This is very serious. Potential, the divergence from the initial mission of the company. As impact first ventures grow, they may face pressure to shift focus or compromise on impacts to improve financial performance. This risk, or what is called mission drift, can be a challenge for investors and organizations dedicated to maintaining a strict focus on impacts. As time goes on, human beings, it's difficult to stay disciplined. Discover that with time, the organization may start deviating from the impact motive and start tilting towards financial benefits. So that drift is something you must watch out for, because it does happen. Number 9 is lack of standardization. Without consistent standards of reporting framework, impact-first investing can vary widely, making it difficult for investors to compare opportunities or trust that impact claims are authentic, particularly with the risk of greenwashing. And it's difficult to accurately measure impact. It's somewhat complicated, because somebody close to me work with one of these NGOs. If you look at the kind of data they would obtain to be able to measure the impacts, it's tremendous and it's tedious. Number 10 is higher administrative cost. Impact-first investing often involves more comprehensive impact reporting and oversight, which can increase administrative costs, reducing the overall financial efficiency of the investment. So because of the nature of the task, the nature of running a typical company with impact in mind, discover that the administrative costs of impact reporting and oversight and monitoring, obtaining data, it adds up to the cost of running the venture. And so these disadvantages highlights the unique challenges of impact-first investing, which requires a balance of financial flexibility and commitment to mission-driven goals. And so investors focus solely on maximizing financial returns may find impact-first investing less suitable, whereas those passionate about societal or environmental changes may find the trade-off worthwhile. It depends on your focus, depends on your values, and what you are willing to sacrifice in order to, create impact and as well as get a decent profit as a result.